Hi, this is David Humphreys, and I thank you for downloading my workbook and this tutorial on the interest rate time bomb. Before getting into the tutorial, there's a couple of paragraphs I'd like to read from the narrative. It's not a question of will interest rates rise, but when, and then by how much. Now, in this workbook, if any of the results turn red, you need to be taking action today, regardless of when you think interest rates will rise, because you can't increase the rent by the amount necessary to maintain your cash flow on the day that your interest rates increase. Even if it's possible to increase your rents sufficiently to maintain your cash flow, the rent increases will have to be small and often, possibly every 6 months. And that policy will need careful management, and you need to start today. Now, let's look at the variables and the relevance of each one. The first variable is the number of properties, and you can put one property in, as is the case in this example, or you can put 10, 15, 20. Next, the total purchase cost, including the cost of buying and refitting, acquisition and refit of all the properties, and their total current value. This is the global value of all the properties and the global cost of buying all the properties and fitting them out. The total of all loans across all properties. The average loan per property is an autocalc by dividing the total loans by the number of properties. The total monthly loan payments. The average monthly payment per property is again an autocalc by dividing the total monthly loan payments above by the number of properties at the top. The average interest rate is also an autocalc. And now we need the rents, the current total monthly rents. The next variable allows you to either increase or decrease the total monthly rents. It may be that you are having to reduce your rents because of the LHA regulations. On the other hand, if you are letting with an option to buy to a tenant, it may be that you can increase your rents. Either way, you adjust your current monthly total to a new total. If the current monthly total remains the same, then enter the same total under the option or reduced total monthly rents, and it is this rent which is used in subsequent calculations. Next, we want the letting and management, including VAT, percentage that you are paying, and if you are going down the DIY route, do not zero this percentage. Even if you are DIYing the letting and management, you will still have some letting and management costs. So enter a small percentage, maybe 2 or 3%. By the way, if we don't agree with any of the variables or the value of the variables that you've entered, the variable will turn red, or pink rather. Next are your monthly insurance premiums, followed by monthly repairs and statutory checks. Now, monthly repairs is reasonably easy, but if you do have statutory checks carried out for gas check or electrical safety checks, then divide the cost of the checks by 12 to produce a monthly figure. If you are owning leasehold property, enter the monthly leasehold costs in this cell. The next question that arises, do you let furnished or unfurnished? If you let furnished, the answer is a Y. If you let unfurnished, the answer is a no, N for no. And now we need to know the number of void days in the year that you think will occur in each property. Annual void days, because your rent will be reduced by the number of days you enter. Next on the list is your tax rate, including NIC. Now, the reason for including NIC is that if you are DIYing the letting and management, and probably the repairs and maintenance as well, it could be argued that your profits are your income on a self-employed basis, and therefore you may be subject to NIC on the letting profits. If you are using a letting and managing agent, this potential problem wouldn't arise. The next variable is what you think the long-term annual gain rate will be across your property or portfolio. Having entered all these variables, your monthly tax-paid income is an autocalc. We then come to what you may regard as an unusual variable, your committed personal spend. If, as is the case in this example, you have a monthly tax-paid income of £176.74p, having taken into account tax, having taken into account annual void days, having taken into account all your costs, and you can be reasonably certain that you're going to receive this money each month, then the probability is that you will commit part of it, or some of it, maybe all of it, but certainly part or some of it, to other costs that you have outside of your rental business. And if the result of interest rate rises is, as we will see, to reduce this monthly tax-paid income, then your committed personal spend may come under pressure. The 21st variable is, when do you think interest rates will rise in terms of months? And however many months you put in, the month and year will be displayed below in this cell. Now, on the question of when will interest rates rise, don't think just in terms of the Bank of England base rate rising. In my opinion, lenders will increase their rates well before the Bank of England moves on interest rates. And the reason for that is that lenders have got to attract money to lend, and the only source of that money is savers. And they've got to offer savers reasonably good rates of interest to persuade them to save with a particular lender or bank. And the banks will not be looking for the old pre-credit crunch 0.25% margin on top of their saving rate, but will probably be looking for 2, 3, 4%. In any event, put in the number of months before you think your interest rates will rise. Well, that's all the variables that you need to enter for a fairly complex series of calculations below. And now we come to the results. First of all, we start off with the current position. Currently you're paying an interest rate of 2%. You have monthly interest payable of £100, a net monthly pre-tax income of £295, and monthly tax paid income of £176.74p. Now, if interest rates were to rise to 5%, that's 5% payable, by the way, which is a cumulative increase of 3%, the monthly interest payable would rise from £100 to £250. Your net monthly pre-tax rent would reduce from £295 to £102. And your monthly tax paid income would reduce from £176.74p, the same figure as in the variables, to £61, a reduction of £39. Now this reduction is after taking into account your committed personal spend of £100. You in fact are in surplus, technically speaking, of £61 a month. But if you take into account the committed personal spend, and that's the reason for introducing this variable committed personal spend, in fact you will be £39 in deficit monthly if interest rates went to 5%. Now, the first four interest rates are 0.25% increases from 5%, 5.25%, 5.5%, 5.75% to 6%. We then go up in 0.5% variables to 7%, and then 1% variables to 8%, 9%, and 10%. As you can see on the bottom line, the surplus shortfall is in red the whole way through. But when we get to 8%, and this is a figure that most people think interest rates will rise to, this is the pay rate. In fact, at £48, minus £48, you have a negative position even before tax is paid, because your net monthly pre-tax rent is minus £48, and you remain in negative cash flow thereafter. And this is why it's so important that you judge when your interest rates will rise and by how much? How high are they going to go? Now, the next panel looks at the new monthly rent and annual rent increases required to maintain your current cash flow. And your current cash flow is £176.74 a month, with £100 committed to personal expenses which are not related to your rental business. And that same £176.74p is brought into the results, the first column of the results, the current position. So let's look and see what has to happen to your rent over the next, in this example, 36 months. In 36 months' time, you need to, if the interest rate goes up to 5%, you need to have increased your rent to £670.45p. An increase in the monthly rent over the current rent of £220.45p, or a new weekly rent of £154.72. This means that there's a weekly increase over the 36 months of £39.34p, or each year the rent has got to go up by £13 each year per week. This is an annual percentage increase in this example of 8.47, which is nearly 3 times the current rate of inflation. It's certainly over twice the current rate of inflation. And that gives you a net monthly tax paid income of £176.74 in this example, the same figure as the current position of £176.74, which came out of the variables. Now, as the interest rates increase, so the rents have to increase as well. So at 5%, you're looking for an increase in 3 years' time, a rent payable in 3 years' time of £670.45p. We'll ignore the pence. But going up to 8%, the new rent has to be £840 or £841 a month. That means that each year the weekly rent has got to increase by over £26 a week, or a 13.5% increase, and that just isn't possible. You certainly can't turn up to your tenants on the day after your increase and say, by the way, can I increase the rent by X amount? In this case, it would be £78 a week. They just laugh at you. So, as I said in my introduction, any increases will need to be staged very carefully and managed very carefully, and you will need to be increasing your rents each year or maybe even each 6 months, so that when interest rates do finally start to go up, if they aren't already going up at the moment, you are ready for it. There is no point in waiting for the interest rate hike to hit you, because by then it will be too late to take any action. The next panel looks at the asset recovery years. Where the current value is less than the total original cost including acquisition and refit, we work out the number of years it will take for the current value to reach the original cost at a gain rate of 2%, for example. Likewise, where we are in negative equity, how long will it take for the value to increase to equal the total amount of loans? And in this example, it takes 20.5 years for £50,000 to increase in value to £75,000, and it takes 9.2 years for £50,000 to increase to £60,000. And in both cases, I've given you the actual month and year when this equality or equalizing will take place. Now, in many cases, landlords use the equity in their private homes to fund their buy-to-let business, and taking out loans on their private homes and using that money to buy buy-to-let properties. So in this workbook, I've included a page so that you can analyze the situation on your private home. And here it is. And once again, I would like to read part of the narrative. This blueprint calculates the amount that your income has to increase by to pay your new interest rate mortgage after you have paid tax and national insurance on your increased income. If you don't want the increase in interest rates to affect your lifestyle, Once again, you need to take action today. Now, I've noticed that when anybody in the media, the national media, talks about the cost of an increase in interest rates on a mortgage, they simply talk about the net cost, not the gross position. But before that increase can be paid, a gross income has to be earned, which is taxed. So if your marginal rate of tax is, say, 40%, and your interest rate, or your interest payments rather, go up by £100 a month, you're going to have to earn closer to £200 a month to pay that extra £100. Anyway, let's look at the variables that you can play with in this example. First variable is total of all home loans, and this would include any loans taken out for the purposes of your buy-to-let business. Your monthly loan payments, and once again the average interest rate is an auto-calc. Your personal tax rate. Now you need to remember, this includes NIC by the way, you need to remember that on top of your tax rate of, let's say, 40%, as a self-employed person you could be incurring 9% NIC, so your actual tax rate in reality is 49%. The next thing we need to look at is whether you have any monthly surplus income. Do you have any slack? Could you afford to pay an extra £50 on your mortgage without it affecting your lifestyle? Now I need to also know the original cost of your property, including acquisition and refit, its current value, and once again what you think the local annual gain rate will be. Now we come to the results, and once again we have the current position, an interest rate of 2.83% based on the figures in this example, and a monthly interest payable of £250. Now if the interest rate rises to 4%, then the cumulative interest is increased by 1.17% in this example, and the monthly interest payable rises from £250 to £353, an extra monthly payment of £103. To generate that money after tax and NIC, you would need to earn £203, an extra £100. And that would reduce your monthly surplus, currently £150, to £47, and involve an annual extra payment of £1,240, and you would need to be earning close on £2,500 to pay that extra £100 a month. Once again, we've got 10 interest rates. The first 5 go up in 0.25%, then 0.5%, and then 1%. And the moment these numbers turn red, it means that your monthly surplus income has been wiped out or fully absorbed. And it then goes to calculate the extra monthly income you need to make up this shortfall. So if your monthly shortfall is £20, you're going minus £20, you will need to earn an extra £38 to make that money up. And finally on this page we look at the home recovery years. How long is it going to take the current value to rise to equal the total original cost, assuming that the current value is less than the total original cost? And how long is it going to take the current value to rise to equal the total amount of loans outstanding on the property? In this case, it is 11 years for the current value of £100,000 to reach £125,000, and that great day will take place in July 2023, and in case of the negative equity, it will take 3 years to get over that problem, and you'll have to go to March 2015 for the value to equal £106,000, which is the amount of total loans in this example. Okay, well that brings me to the end of this tutorial on this interest rate time bomb. I hope you found it interesting and worthwhile. I thank you for listening and watching, and if you want any help, advice, please email me at help@buy-to-let.com and I'll do what I can to help you. In the meantime, I'm signing off, and once again thank you, and I hope you have a very good day, regardless of the shocks that may be contained in this workbook and tutorial.